Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning. This is Quincy Krosby. It is The Talking Point. It's Monday morning, August 19th. And right now, the market looks as if it's going to be a little bit careful going into this week because even though there isn't a huge amount of data releases, on Friday, we have Chairman of the Federal Reserve, Jerome Powell, speaking on monetary policy at the Federal Reserve's big meeting, or confab as they like to call it, out in Jackson Hole, Wyoming. And you'll hear more and more discussion about it this week in the press, the financial press, as to, what could he be telegraphing to the market? Certainly, he is going to lead the market towards the September 18th meeting. And by the way, the futures market has the Fed cutting rates by 25 basis points. There's not going to be that much data released this week. But however, what is going to happen on Wednesday morning this week is that the Bureau of Labor Statistics is going to come out with a preliminary report about the revision to the establishment survey. That sounds complicated, right? But to distill it, what it really is whether or not between April 23rd and March of 2024, what happened to the numbers concerning how many new jobs were actually created? And so you could argue that all they do is count every month how many new jobs were created. What this report does from the Bureau of Labor Statistics is it correct? Was the amount correct? Or do we need revisions? One camp in looking at this suggests, hey, wait a minute, you know what? Based on our data, we believe that there was maybe too many jobs that were announced, that were created. And maybe, in fact, they really aren't real jobs. Maybe that needs to be revised downward in terms of how many new jobs were actually created. Now, remember, this is a preliminary report, and then obviously there'll be another one. But nonetheless, I mention this because Chairman Powell has increasingly talked about another mandate besides the price stability mandate, which we call the inflation mandate. He has been talking more about the mandate called maximum employment. And that is a mandate that comes straight from Congress. And what it does is it tells the Fed, you need to help create an environment of sustainable economic growth that can create jobs. And that's an important mandate for the Federal Reserve. And so what will be very interesting is to see if in this report comes out on Wednesday morning at 10 o'clock a.m. Eastern time, whether or not it agrees with the reports that came out month after month, payroll Friday, or does it suggest that there were inconsistencies in those reports? And if so, what were those inconsistencies? It's going to be interesting. It may sound getting really into the weeds about the labor market, but you can see how important the labor market is for consumer spending. And that is a very important link, considering, as I say every single week, the consumer is one of the most important key components of this economy's gross domestic product. So that should be very interesting. And again, the only reason I'm mentioning this is that Chairman Powell himself has been invoking that mandate so many times and has said increasingly, if we see a deterioration in the labor market, we will come in and act quickly. And what he means is cutting rates quickly. So this is important. And again, right now, the market had a very nice run. Why? Because we saw that the initial unemployment claims came down. They were kind of level, nothing to scare the market or any analysts suggesting that the initial unemployment claims were rising at a rapid pace. That has not been shown in the most recent Thursday morning reports. What we have seen, however, is that continuing claims continue to inch higher, suggesting that folks are having a more difficult time finding new jobs. So in any event, I'm putting this there because what he says on Friday is going to be interpreted and analyzed for what we can expect at the next Fed meeting. And again, right now, the market is suggesting that we will have a rate cut of 25 basis points this week. And I do want to add from last week, because last week also surprised the market with retail sales climbing higher. Remember, again, why retail sales are so important. It is about the U.S. consumer, which is the largest component within the gross domestic product reports for our country. And retail sales came in surprisingly higher. And, at the same time, we heard from Walmart, we were going towards the end of the earnings season, and Walmart came in and surprised to the upside, said, look, yes, people are more careful. Absolutely. They're more discerning. Absolutely. But they are spending. And he talked about, the CEO talked about the health of the U.S. consumer. He said the consumers remain resilient. And that, coupled with the retail sales numbers and in addition to that, the initial unemployment claims remaining level, remaining stable, was important for the market. So in any event, this week, it is really about Friday morning, when it'll be 10 o'clock Eastern, I believe, that we hear from Chairman Powell out in Jackson Hole. But on Wednesday morning at 10 a.m. Eastern, we will get that Bureau of Labor Statistics report, and we'll see if there's anything in there that should be of concern to a Federal Reserve that has a mandate for maximum employment. This week, we will hear more Fed speakers. Now, I do want to point out that we have heard a number of Fed speakers over the last couple of weeks suggesting that they are not quite ready to pull the trigger on cutting rates because of inflation. They say, you know what? We still need more information to see that inflation is really, really coming down to a level that we don't have to worry about another spike higher. So I just want to report that. So we'll see what they have to say this week, because this week we actually have a number of Fed speakers coming out, and we'll see if they mention anything about inflation and whether or not they need to wait a bit longer before they actually, agree that we need to cut rates. Also today, Monday, August 19th, we'll have U.S. leading economic indicators, and the expectations are that they will come down, they will weaken a bit more. And, this has been one where sometimes the actual numbers show consumers actually a little bit more upbeat about the future. But we'll see what these economic indicators have to say. It will be for the month of July. Also, this week, we will get the minutes from the last Fed meeting, and that comes out on Wednesday at 2 o'clock. The market basically wants to see, was there any discussion about perhaps cutting rates more forcefully, so that 50 basis points rather than 25 basis points? Is there more concern at the Fed about the labor market? And do they believe that that is, not just a one-off about the labor market, but rather a deeper concern about a more deteriorating labor market? I use that word because Chairman Powell has talked about if the labor market deteriorates at a faster pace, the Fed would be more inclined to come in and cut rates quickly. Also this week, we're going to have existing home sales. Expectations are that they actually did pick up just at the margin. So we'll see, because some of the home sales numbers and the home sales reports, realtor reports haven't been particularly strong. There's still concern that the mortgage rates remain high, although they're starting to come down as the inflation reports actually begin to ease. We're also always focused on those initial unemployment claims. That comes out always on Thursday morning at 8:30. Expectations are that they inched just a little bit higher, nothing that would be alarming. And then again, we look at the continuing claims. There will be an S&P Global Flash Services Purchasing Managers Index report, and another one for manufacturing. Now remember, S&P Global is different from the ISM Institute for Supply Management purchasing manager reports that the market pays very close attention to. And by the way, the last reports that we had showed that the service sector had picked up, including employment. And that report that came out a couple of weeks ago actually helped steady a market that was worried about declines in the service sector, which is the largest part of our economy. So this week, the flash report, by the way, means it's not final report. It's just a quick report. But it comes from a different agency or company, and that's the S&P Global. So that will be on Thursday morning, both for the service sector and manufacturing. And then, of course, Friday is Jerome Powell, and we'll also get new home sales. And that expectation actually is that it climbed just a little bit higher. But everyone will be talking about Jerome Powell. All week long on TV, everywhere, it will be, what is he going to say? How is he going to characterize the U.S. economy? How is he going to suggest or telegraph what we may expect at the September meeting on September 18th? So it's going to be extremely important for the market because ever since he's been Fed chair, he has been telegraphing to the market what they can expect. And we all remember the time that he basically told the market, you are going to better expect that we are going to keep rates higher. You remember that? That was a couple of years ago, and the market just sank as he was talking. So now, again, what the market is expecting, that he will lead us towards a rate cut for September 18th. The question will it be 25 basis points? Or there are those who say, hey, wait a minute, maybe it'll be 50 if, and this is the big if there is a concern about the labor market. So there's a lot for the market to digest, even though it doesn't look like that when we look at the calendar of economic data releases. Have a very good week. And by the way, I do want to mention we've got a number of questions regarding when does NVIDIA come out and have their report? Haven't we seen NVIDIA with all of the other big mega tech names? It's because they don't report until August 28th, and that would be after the market close. Yes, so that's what everyone is waiting for that. But I will say, in terms of the market, we're paying very close attention to the leadership in the market. And I'm paying very close attention to, are we seeing consumer discretionary leading? Or are we going to see a pickup in consumer staples? Because obviously one sends a signal. Consumer discretionary is that folks are okay. They can spend a little bit or more money on retail sales. And then obviously we know why you would move over to consumer staples. We want to see this week which one is leading the market. And similarly, as we look at it, we want to see whether or not small caps continue to begin to inch higher. Remember, they are very much data dependent on rates coming down and also on economic conditions, because it's clear if you're a small or mid-sized company, you need to have where you were living, the region you're in, the city you're in, they need to have a positive economic backdrop. So we pay attention to them and see what they have to suggest just by how they're doing and which sectors are doing well within the small and mid-cap. We know that when the banks are doing well, these are the large banks in the country, typically because small and mid-cap have a preponderance of banks, smaller banks, they tend to pick up that positive effect from their larger brethren. We'll see how that plays out this week. Have a very good week. We'll be back next week. Thank you so much.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.